Today's topic is on the Federal Reserve. The Fed has arguably the most concentrated government influence on the economy. Economic policy in the U.S. is divided into two main areas or two main spheres of influence. The first area is fiscal policy, and I think it's what most Americans are familiar with. Congress decides on a budget that comprises of taxes and spending, and then the president signs it into law. So it takes over 500 or so people working together to form our fiscal policy. During the 80s, President Reagan had to work with a Congress with a majority of Democrats, and the Democrats had to work with him or he could veto their budget. The reverse was also true in the 90s, with Clinton having to work with a Republican majority in Congress. More recently, during the last 2 years of President Bush's term, the Democrats had a majority so strong they could override presidential veto. They often did, and they still can. And while this may indeed be an imbalance of power, it still takes hundreds to agree on a budget. The second area of government economic policy is called monetary policy, and that's the exclusive domain of the Federal Reserve. And the chairman of the Federal Reserve is their chief policymaker. The chairman is appointed by the president for a 4-year term. The current chairman is Ben Bernanke, whose term expires in 2010. And he was preceded by Alan Greenspan, who was chairman for over 18 years and was appointed and reappointed by 4 presidents. Now, while the president may be the man, or someday the woman, who appoints the chairman does not take orders from the president. He does not answer to anyone. Economists like to say that the president can influence the Fed through moral suasion, which basically means the president can say pretty please to the Fed, but that's about as far as it reaches. The Fed is not beholden to popular sentiment or special interests. So which area has more influence on the condition of the economy? Fiscal policy that the president and Congress make, or monetary policy which is decided by the Fed chairman? It's hard to say, but sometimes they work congruently to accomplish certain objectives, sometimes they don't. But it's fairly clear there isn't one man with more influence over the economy than the chairman of the Fed. What has the most influence over the economy are the expectations and behaviors of billions of people like you and me participating in the free market. Expectations play a powerful role and are often overlooked in economic analysis. I'll be talking more about expectations in my next lesson on inflation. Okay, so what does the Fed actually do? We know it controls monetary policy. What does that mean? As I mentioned in my previous video on public debt, when Congress spends more than they collect from taxes, they get additional money from the Fed. Then the Fed has to borrow that money and pay interest on it. So, how does the Fed borrow that money? Well, have you ever seen a U.S. savings bond? Maybe your grandparents have some that they bought during the war. It's a type of government security. There are also T-bills and other types of government debt investments. You can buy a bond from the government, the Fed pays interest on it, and at a later date you can cash it in. So if you add up all those savings bonds and T-bills and other investment instruments issued by the government, you'll have a multi-trillion-dollar amount that is the national debt. So when you buy a savings bond, what you're really doing is loaning the government money. It's really that simple. You may have often heard that China loans great amounts of money to the U.S. But in order to invest in debt instruments issued by the government, you have to be a U.S. citizen. However, a U.S. investment company or insurance company, etc., may buy these and repackage them and sell them to a foreign party. So there's a third party, a U.S. company, in between the U.S. debt and the foreign party. Because China is such a hot topic, I would like to show just how much U.S. debt China holds and get this subject out of the way so it's not a distraction, so we can move forward with learning how the Fed really works. If you look at the chart, 28% of the national debt is held by foreign nationals or foreign governments. In the next chart, you'll see that 28% slice of the pie, China holds only a quarter of it, which comes out to 6.7% of the total debt pie. So of all the U.S. national debt, 6.7% is owned by the Chinese government and Chinese investment companies. While this is billions of dollars, it's still a very small percentage of the total U.S. debt. On a side note, it is in China's best interest that the U.S. has continued success if they hope to continue collecting interest payments on their U.S. debt investments. In the previous lesson, I mentioned that most responsible economists feel that a healthy amount of U.S. debt is between 30 and 70% of GDP. Well, wait a minute. Why not 0%? Why isn't that healthy? Well, in order to fight inflation, the Fed needs to control the money supply. In the next video, I'll discuss inflation in more detail. But for now, suffice to say, if there are too many dollars in the market, the value or the purchasing power of each dollar declines. It's a basic supply and demand principle that applies to money itself. Here's an example. If you have a glut of apples at the market, you can only sell them for a few pennies a pound. But if you have the world's most delicious apple, imported from Aomori, Japan, a rare crop that is imported in very limited numbers, you can charge $5 a pound. Dollars are no different. If there are too many dollars in the free market, their purchasing power declines. They have less value. Just like it was in the late 1970s when the U.S. had double-digit inflation. During the Great Depression, however, the money supply was severely constricted and each dollar had tremendous purchasing power. Well, that extreme isn't good either, because the super constricted money supply is actually what caused the Depression in the first place. The Fed in recent times has learned to take on the role of stabilizing the US dollar, so we don't suffer from deflation, and we enjoy a very slow inflation of the US dollar. So the Fed has three tools it can use to control the money supply, which in turn fends off high inflation. The first tool it has at its disposal is the cash reserve ratio, or CRR. The Fed tells banks, private banks, that they have to keep 10% of their deposits in cash. Say, for example, you deposit $100 in the bank. The bank is only allowed to loan out $90 of your deposit. So if the Fed wants to contract the money supply, one way it could do it is to tell banks to increase their reserve ratio. So more money would be sitting in banks instead of out in the free market. However, the Fed is very reluctant to use this tool. It's a bit of an accounting nightmare for banks if their cash reserve ratio were to constantly change. But it's a tool the Fed keeps in its back pocket. The second tool the Fed has to control the money supply is interest rates. The Fed loans money to banks at a certain rate, and then banks in turn loan money to private companies and individuals. So if the Fed wants to contract the money supply, it can raise interest rates at which it loans money to banks. In turn, banks will have to raise their rates if they want to make a profit. So by raising rates, it has a two-prong effect on the money supply. For depositors, a higher interest rate will incentivize them to keep more of their money in the bank, hence less money in the free market. And for borrowers, higher interest rates means the cost of capital is higher, and loans will be less attractive, again resulting in less money in the free market. The Fed can keep raising interest rates until the desired level of contraction has been reached. However, if the Fed wants to expand the money supply using interest rates, it has a limitation. As the Fed lowers rates, the money supply is expanded. But once you hit 0%, the Fed no longer has any ability to further expand the money supply through interest rates. We are currently at near zero interest rates from the Fed, and the U.S. money supply has doubled in the last 5 months, something I really want you to keep in mind when you're watching the next video on inflation. As a side note, the euro has only one tool to adjust the money supply, and that's interest rates. US has 3 tools, euro has 1 tool. So keep in mind when making European investments.